Hopefully more people can join. So thanks everyone for joining our event, Investor Meeting Prep, how and what to prepare to impress during an investor meeting. So investors see hundreds, if not thousands, of pitch decks every year. If you've secured their interest with your initial pitch, the next big hurdle is the investor meeting. So fortunately, we've got some fantastic speakers joining us today. We have Toku CEO Thomas and Seed Legal's APAC product lead Lester, who are going to share insights on what investors want to hear during your investment meeting and what you need to prepare to give yourself the best chance at securing the investment you're looking for. So before we go into the discussion, for anyone who's not familiar with Lanturn, we are a corporate and fund services firm centered around helping startups, SMEs, asset managers, and investors grow their business and portfolios. We achieve this by offering an unparalleled user experience through tech and our expertise. Anyway, that's enough about Lanturn. But before moving to the discussion, I am going to quickly ask the speakers to introduce themselves and tell us a little bit about their background and their company. So firstly, Thomas, if you could go ahead and introduce yourself.
Absolutely. Thank you, Francesca. Well, thank you for having me, and good morning to everyone, or good afternoon if you are not based in Singapore. So I'm Thomas Laboule. I'm the CEO and founder of Toku. Toku is a Singaporean company. We are a cloud communications and a customer engagement platform. But you can learn more about us by checking out the website. It's not really the topic for today. In terms of my background, I think that the relevant portions are the fact that I worked for a family office and as a consultant before being hired to restructure a company that needed also some fundraising. And later on, I started Toku in 2018 and had to go through the different stages from seed to pre-series A, series A just now. And so, yes, quite an extensive understanding of the startup ecosystem and fundraising ecosystem in Singapore and Southeast Asia in general.
Thank you, Thomas, for that introduction. Very happy to have you here. And Lester, can you introduce yourself and Seed Legals as well?
Of course. Hello, everyone, and thank you, Francesca, for having me here today. I'm part of the Seed Legals APAC team, and at Seed Legals, we see ourselves as an operating system for very early stage companies. We automate all the legals that early stage companies need and just facilitate their team building and fundraising activities. So by way of background, I'm also a counsel at Cordial Law, and in that capacity, I work exclusively with the users of Seed Legals. I am, as my experience with Cordial Law would suggest, a lawyer by training. I used to focus on M&A, private equity, and venture capital, and I have represented both the buy side and the sell side. So I'm very keen on hearing more about Thomas's experience, because unlike him, I've only been across the table, but he has actually been at the table. So I think this will be a fascinating session.
Thank you, Lester, and thank you both for joining us today. So yeah, I'm really excited to have you on the panel. I'll dive straight into the questions, starting off with quite a general question. And I think I'll ask you first, Thomas, but the question is, how do you start your fundraising journey?
Sure. So look, I think there are many ways to start, but as part of the necessary questions to ask yourself at the very beginning of the journey, because the beginning of the journey will be also the foundation for the next rounds and so on. So figuring out early on what is going to be, for example, the structure of your seed funding, which is generally the first round. I know that some are doing a pre-seed as well, definitely if they are pre-revenue. But typically, it's more or less the same as the first round that you do, where you need to define, is it going to be directly equity? Is it going to be a convertible? So there is some questions there. And obviously, the valuation question will very quickly be on the table. So before going into meetings, it's important to brainstorm, ask some advice around you and your network and to people that have already done it. Understand also what are the benchmarks in your industry for similar companies in order to calculate the multiples that will not surprise in either way the investors that you will start talking to. And then obviously deciding which investors you want to target. And that is going to require some research, especially if it's the first time you do something like that, because you want to make sure that you are targeting investors that are interested in what you do in your industry, B2C or B2B, that are also at the right ticket size for you. So there are different questions that you need to ask yourself before diving into actually securing meetings.
Yeah, if I could just build on that, if everything that Thomas said, if you as a member of the audience is not frightened about the prospect of fundraising because it sounds like a mountain of work, then, well, it is. It is a lot of work when you are embarking on your fundraising journey. And if you're an early stage startup, if you're just incorporated, then, well, the bad news is that you are already on a fundraising journey. You really should be on a fundraising journey already, because a lot of these things take time, right? So we often see the fundraising journey at the very earliest stages takes about anywhere between 8 to 12 months to complete. And from day one, you need to start thinking about, okay, how much do I need, and the structure of the funding round. What's it going to look like? And why do I say that your journey has started now? Because right now, today, you need to start thinking about the fundamentals behind your company. And I don't just mean, for example, that you are revenue generating or profit making. I mean, have you structured your founders agreements properly? Have you made sure that all your IP has been assigned to the proper entity? These are things that investors will be very keen to look out for. And so it's best practice to really start thinking about these details before you even start talking or thinking about what kind of investors to approach. Make sure that you've got your fundamentals sorted out.
Completely agreed. And then once you do, and if you are not familiar with the questions that you could have, try to also select maybe either VCs or investors that you know already, and that would be a more friendly audience, or ones that you don't necessarily want, and then you can exercise. But don't go directly for those that you have identified as the ideal investor, because obviously there is such a learning curve. And that's why I think, Lester, you're very right to say that the first round is going to be 8 to 12 months, because there is a learning path. If you are familiar with fundraising and your pitch, your fundamentals are right, you could do it in 6, but better to play it safe and target that it's going to take up to a year. And that's why you need to start sooner than later, especially if you don't have a lot of financing when you begin. Your own funds or friends and family, like they often say, you kick off your activities with that, but that only bring you that far, right?
Yeah, the funny thing is that a lot of people have the impression that the later stage, bigger rounds tend to be more difficult. And yes, they are indeed more complex in their own ways. But from my experience, it's the very earlier stages that take the longest time, the most negotiation, and the most amount of elbow grease involved. And yeah, so Thomas, I understand that you've done a few rounds now. Maybe you can share more about your experiences for those kind of different rounds.
Well, first of all, I agree with you. When I look back, the first rounds, actually, we did a seed funding and 2 tranches for that seed funding. That was the most complicated, because first of all, I didn't know many seed funding investors, because with the family office that I was working with, we were targeting larger rounds and later stage companies. And so it is a very different way of pitching and approaching. You are dealing typically in the early rounds with angel investors rather than with institutional investors. And yes, it's very different, because every angel investor is going to be looking at different things. It's a lot like, it's like sales, right? So you need to make sure that you identify your ideal target audience, like you would do for selling your product or your services. And then also being able to know in advance, or to detect very quickly, if there is actually a match. And what I did wrong in the first meetings, like first 20 meetings, is always trying to adapt and change my storyline to convince the investor. And actually, once I understood that there are so many different investors, that it was just an uphill battle, and I was better off sticking to the only version. Obviously, you're gonna adapt some of the pitch. If they are very technical, you're going to concentrate on the product. If you're in technology, if they are more finance oriented, you're going to focus on that. But it's very important to stick to the same vision for the next rounds and what is the investment horizon that they have, just to make sure that you're sufficiently like-minded, because the earliest investors are also those that will define the later rounds and are eventually going to make it more complicated to close the shareholders agreements with the institutional investors. So it's important to identify the angel investors right away. And once you have confirmed their interest and you are a bit further in the process, even to check with their other portfolio companies on how do they behave. Are they very active? Are they very opinionated, or are they passive? So that you know what you're stepping into. It's like a marriage.
Thanks, Thomas. That was really helpful. And yeah, going back to your previous point of kind of starting off with investors that you perhaps aren't so keen to onboard, they're not your top priority in order to practice. I think that's something that's brought up. I remember previously on a previous webinar. So I think that's great advice. And I think you have already kind of touched on this a little bit just in your previous discussion, but I would maybe ask Lester this as well. But what are the key things to bear in mind when preparing for a pitch?
Well, Thomas has actually laid the groundwork for me already, and I think the most important thing is to know your investor, know who you're pitching to. The difficulty with that question, Francesca, is that there's so many different types of pitches because they have to be tailored to the investor they're speaking with, right? And it's very easy to talk about headline terms like know your pain points well, know your fundamentals. It's very easy to say such things, but ultimately at the core is know what the investor is looking for. Some investors are looking for a very long play. The investment horizon could be 5-10 years. And with that, they're less concerned about your ability to turn a profit within the next 2 to 3 years. Instead, they want to see, all right, are we talking about a greenfield opportunity or a brownfield opportunity? If you're speaking to perhaps angel investors who sometimes have much shorter investment horizons, you may want to put in a bit more work to convince them that actually your startup is going to turn a profit. And one very important point that a lot of founders forget is that the pitch it's a two-way communication. And it's also a chance for you to find out more about the investor and whether it's a good fit for you. So sometimes I do tell founders, consider putting in requests in your pitch. Make it really clear to the investor what you're looking for in an investor, how much you want to raise, and say, okay, do you need them to perhaps tap into your networks for you? What exactly, what kind of assistance your company is exactly, and that's also a way for founders to suss out and have a feel for the investors, because as Thomas said, it's like a marriage, and you don't want to just blindly accept this first proposal that you receive, right? You kind of want to know your investor a little bit better, and it all starts at the pitch.
Mm-hmm. Correct. And when you say you don't want to accept the first offer, that also implies that you started on time, right? Because beggars cannot be choosers. So that's one thing that in the early rounds you very often have, is just the fact that, oh, you finally have an offer, finally have the money, you needed it already yesterday. So you're moving on, and there are some of these compromises that you would do to close the deal early on that will actually make it more complicated for you later. And in terms of getting to know your investor, what is going to be complicated in the seed round is that angel investors typically don't have a web page or a website. You cannot find their portfolio companies. It's more difficult to prepare in advance unless you already know someone that can mention you some insights maybe. Otherwise, it's really like a sales meeting where they need to talk first. You need to ask them a few questions about who they are, what they do, how long have they been investing, and just keep it casual, of course, a bit of small talk, but try to use that directly as a way to adapt your approach, your angle, and also identify if it's worth in the long term to continue the conversation. And in terms of the pitch itself, don't focus too much on the slides. The slides are important, and don't get me wrong, you need to have strong supporting visuals. But what I did at the beginning to always change the version of my deck for the person that I was going to talk to. At some point, it's just not manageable. It's not scalable either. You spend a lot of time with that. As soon as you have a good boilerplate and like 10, 20 slides, it's not about doing the presentation like just following the same chronology. You can actually jump from slide to slide depending on the conversation that you're having. It's really important that it is a conversation rather than a dry presentation, because there, if you choose wrongly in the approach or how you start, you can very quickly lose the attention of the person you're pitching to, and it's already over before you know it.
Yeah, definitely. I mean, just going back very quickly to knowing your investors, it's really hard sometimes to find out information about the investor they're pitching to. And I always advise against stepping into a room cold. And of course, as early stage startups in a hostile funding environment that we are in right now because of the recent economic developments, you may find yourselves without much of a choice. Nevertheless, I do strongly suggest and advise founders to do a bit of due diligence, speak to as many people as you can, and really sometimes it's just about tapping the right spots. So my favorite story is we all know about how crazy investments are like in the Web3 space, right? But I think very few people truly appreciate that, because I actually had founders telling me that, oh, all I had to do was show my investors a Notion page for an idea that would be developed in about 3 years, and they just gave me millions of dollars, and it's like, oh, that's the easiest pitch I've ever done. Again, and that goes back to the point, right? Know your investors. If these guys have investment horizons that are 10, 15 years, they don't really care that you don't have the best product right now. What they care about more is that you have a really good head on your shoulders, a really good idea, and a good team to actually execute the idea.
Thanks, Lester. Yeah, I think there was so much money floating around in crypto kind of a year or so ago, but I'm sure now those Web3 investors might be give a little more scrutiny to new investments. But thanks for your input. I just wanted to dive a bit deeper into maybe some like specific scenarios. So, of course, almost every founder, even at the early stages, is going to have some key team members that are on the journey with them. Would you recommend bringing along these key team members to your pitch?
Well, I don't think there is really a rule for that. If you're early in the story and you have key team members, I would assume they are your co-founders, and then the answer would be yes. Otherwise, typically for the early rounds, the angel investors and even the institutional investors that are doing seed, they don't really care that much about the team initially. Might be strange to say so, but what they really want to make sure of is that the founder and founders have enough drive to go through the growing pains, and they're really investing in the people first. Obviously, the idea matters and what you want to do matters, but they will be mostly convinced by the person that is having the idea and driving the entrepreneurial journey. So I haven't had any of my team requested in the early stage funding in terms of even seed and pre-series A. There might have been a few investors specifically asking to maybe speak to the person in charge of tech and so on, but it was not really by default or even the majority. While the Series A, there obviously amounts are bigger, process is more formal, even in terms of the DD. And there, it is important that you can show at the Series A and beyond that it's not a one-man show or a one-man show, and that there are indeed key people in the team to drive this forward. But in the initial rounds, I wouldn't say it matters that much.
I take a slightly different view on that, Thomas. And the reason I say this is because there are two sayings in the VC world that come up over and over again. It's that one, ideas matter very little, execution is everything. That's the first saying. The second saying is that VCs don't invest in companies, they invest in people. Right? So I think depending on the stage of your corporate development and the kind of ideas that you're executing, perhaps sometimes it suffices for you as a founder to step up, right? Maybe because you are an expert in the domain, you know the area really well, and all the VCs care about are you and perhaps your co-founder. But for example, let's say I am, me, I'm as I'm a lawyer by training, and for example, if I wanted to enter the tech sector, and I have this really good idea, and I have some networks, but I'm a lawyer. Fundamentally, I'm a lawyer, and I cannot pull it off myself. I need to actually assemble a team of experts in that field that then I can present to the VC, because any investor just looking at me as a lawyer be like, wow, you're pitching a med tech idea to me. You know nothing, right? Yeah, this sounds great, but you know nothing. So I want to see your team member. So really it depends on your profile as a founder.
No, I agree. And obviously, having them at the pitch or having them meet later when you are almost closing, it's not the same thing, right? So obviously, at some point, they need to know that there is more than one or two or three persons driving this. But typically, the slide of the team with the background, what are their strengths, and being able to demonstrate that the team has indeed all the knowledge necessary to drive the idea will be enough. Pitching with your senior developer is, for example, not going to be necessary if I want to caricature a little bit. But yes, I think that for the seed funding, by the way, the team, besides my finance director and myself, the rest of the team, we were 7 when we began. They only met the investor when we actually signed the shareholders agreement. But he knew they existed. That's the important part.
Thanks both Thomas and Lester for your insight there. And this question kind of leads on from your answers. And Lester, you maybe talked a bit about it, giving your example of being a lawyer. But many participants are first-time founders, and there may be participants who are quite young and maybe just graduated university. I met a person at the Accelerating Asia event on Thursday, Lester, he was still in university and had just finishing his physics degree and was starting his own company. So you both mentioned investors invest in people and not ideas. So what is one way that a very young founder can convince an investor to invest in them with when they have very little experience themselves?
Wow, that's such a tough question, Francesca. I mean, if I had like the golden answer to that, I wouldn't be sitting here with you guys. I'm just kidding. The thing is that it varies, right? So I've met so many investors who actually tell me that there is an advantage for youthful innocence, right? You're fresh out of school. You've attained a lot of theoretical knowledge, and you're not yet marred by the pessimism that kind of surrounds us, right? So everyone who has worked around for a bit is a bit jaded, we're a bit more realistic, and sometimes that prevents us from truly reaching for the stars. And some investors really like that kind of optimism. On the other hand, we also have investors who are like, no, I'm only going to invest in somebody who has kicked around that relevant industry for 10, 15 years, because perhaps they're a bit more risk averse in the way they conduct investments. So unfortunately, I don't have an answer to that, right? And maybe that's going to disappoint the audience member that asked that. But the point I'm trying to underscore here is know the investors that you're pitching to, right? If you are fresh out of uni and you just have a really good idea, don't go running to investors that we're probably looking for someone with a bit more of a mature profile. And that applies vice versa, right? If you're an older person, don't go to investors who are looking for very young founders.
No, that's true. And I think that if you know the investor and you know some of the portfolio companies that they have, you can also figure out if they are already investing in older, more senior profiles, or if they have taken a chance with younger fresh grads, for example. Also, what is very important is the personality. So I've been a little bit on the buy side and also participating in a few seed investment rounds and efforts through syndicates in Singapore. And if you have a more senior profile, obviously they will be probably a bit more opinionated, more confident, because they've done it already. right? Or they have the work experience. And so that part is going to be, as you said, a choice from the investor side in terms of detecting what is the risk appetite on both sides, and also how much that opinionated aspect is going to, because you want to make sure as an investor that you can still have an investee that is listening, listening to advice, taking guidance into account, not necessarily always following it, but at least reflecting on the advice. And so if you combine that with the innocence that you were saying, and that fresh grad optimism, which, as you said, is an amazing fuel to drive a journey that is going to be complicated. So that's something that the investor will try to measure, is how much the founding team can go through pain, right? Are they going to give up directly if things get tough? And that's something that you can already detect just through their academic journey and maybe personal stories, and they will ask about that. But it will be very important for them as well that inexperience is not coupled with already too much confidence, too much maybe arrogance, and an opinionated founding team would be very complicated to manage if you know that they are opinionated, but they don't have the experience to be yet. And that could be a blocker for a founder. So you need to find, as a fresh grad, the right balance, obviously, that you need to feel confident enough and show that you're confident enough to start a journey without falling into the pitfall of excess confidence, which looks like arrogance.
Yeah, that's a really good point. So as we're talking, Thomas, it just struck me that perhaps there's an inverse relationship between experience and how important your idea is. Right. So the less experienced you are, the more effort you have to put into convincing the investors that you have what it takes to execute the idea. Right. And then suddenly it's not enough to just go out and rock up to an investor and say, hey, I've got a brilliant idea. You actually need to produce an MVP. You need to have actually tested it. You need to be able to provide a basic product demo. Whereas if you have more experience in the field that you're talking about, it's easier to just go to the investor and say, hey, I've done this for the past 15 years. I know the pain points really well. I don't have an MVP yet, but I'm pretty sure I can put one together. And that's what experience does. It makes that initial conversation easier, but it's not something that is going to bring it all the way through.
Great.
Thanks, Thomas and Lester. That's really helpful, and hopefully that's encouraging to any young founders that are listening. So moving on to a slightly different topic, majority of businesses will have competitors. In most instances, there will be aspects where your competitor's business is superior. Do you have any recommendations on talking about and comparing against competitors during the investor meeting?
Sure. I think that it is important that there is competition. If there is no competition, probably there is no market, right? It would be very surprising that your idea would be a unique idea that no one has had before. So the absence of competition, I think, would be a red flag for most investors, unless it's like in biotech or something that is like deep tech and requires patents that might be more possible. But otherwise, in terms of business ideas, we have centuries of entrepreneurship behind us, and so competition is good. Besides for the fact that the market exists, it's also going to be helpful for the founding team in order to define, okay, what are the benchmarks in the industry? What is the market size? There should be already research about it if there is competition. You're going to have maybe transactions on exit level or funding where you can also use that as a benchmark for your multiples and for calculating your valuation. So overall, the presence of competition is a good thing, and you should avoid saying I don't see any, because that will be very unlikely and might actually show that you haven't done your research or you're overly confident and naive.
Yeah, I completely agree. And to build on that point, it's not just about, I think firstly, tackle that issue head on. Don't try to hide the fact that you have competitors. As Thomas says, competitors are a proof of concept. They are telling your investors that there is an opportunity there to be exploited. What's more important, however, is, what's the size of the pie? That's what investors are interested in. How big is the market, right? Is there space for more than one competitor? From my experience, investors are not so concerned about competitors because they know that there's going to be competitors in any space that is viable, right? If there's a buck to be made, there's going to be someone there. No idea is new under the sun. The question is the field big enough to accommodate multiple players? And the second thing that I would say is that investors are not always looking to invest in the biggest player because that caps their ability to actually make money, right? Your ROI, your multiples are going to be reduced. For example, if you invest in Facebook right now, then if you had invested Facebook when MySpace was still a competitor to Facebook, right? Look what happened, right? So there was a time in that journey where Facebook was trying to play catch up to MySpace. And actually, if you're a smart investor, and a lot of VCs are very smart, they will actually have preferred to invest in Facebook because back then the price per share was low. There was a lot more affordable. They could have gotten a bigger stake in Facebook and then actually see it all the way to 1000x multiples that I think some of those investors get.
Yeah, no, absolutely. And as you said, tackling it head on, I think that in terms of how do you handle it, so besides the fact to acknowledge competition is going to be indeed what are the differentiators? Why is it going to be that you can grab sufficient market share to make it relevant to the investors and to the company as well? Because obviously to be viable, you need to make money and you need to make sure that it's scalable and also present for the foreseeable future, not a need that is only going to exist. For example, during the pandemic, if you base your entire business model on the fact that there is a pandemic in the world, it's going to be tricky to find investors, I think. So it's the differentiators can be multiple, right? And you don't need to be better than your competition on every aspect. Typically, you need to find like 2-3 differentiators. One that has worked well for us is the fact that the competition was less present in the region in Southeast Asia. They were mostly based in the US and Europe. Actually, by now, since they're the only 2 competitors that we had in the region in the same field and that mattered, one has been bought out. They're still present, but they're now driven out of the US, and the other one, unfortunately for them, went out of business. And so there is a massive competition for sure, but most of them are driven out of North America and Europe, and therefore you can play that the differentiator in our case is going to be the focus on the region, the fact that we are present in the region and that we understand the fragmentation of the market and so on. So that is one thing, and then obviously there are other reasons why you can be better. Product can be one, but that is most of the time going to be subjective and also difficult to prove to some investors that might be less tech savvy. So if you're in tech, pitching that your product is the best is not always going to resonate well, because history has shown that it's most of the time not the best product that wins, right? Its execution is being the ability to convert into sales. So there are different things to think about, and indeed, Lester, you shouldn't avoid the competition conversation. It's something that you need to embrace, and then also show that you know your competition, that you know their strengths and their weaknesses, so that you can clearly identify and also anticipate on threats and opportunities that you want to pitch to the investor.
Thanks, Thomas and Lester, for your points on there. And yeah, I really agree with your point on regional expertise. I think even if there's really strong competitors abroad, doesn't necessarily mean that they can successfully enter a new market. And I mean, some of the biggest success stories in Southeast Asia have been Grab and Gojek, and they weren't the first rideshare platforms and like worldwide. So I think that was a really good point. Moving on to a point which I know we have discussed a few times within our discussion already, and you've mentioned some points about getting introductions through people you know, but I was wondering if you have any more practical recommendations on how to do your investor research. If you have to kind of start from scratch, what are the steps that you take?
So in terms of the research, I think that it's your network. It's going to be the databases that you can find as well, Crunchbase and others. There are also a lot of founding teams that have put together lists for different markets where you can find all the institutional investors and what are the ticket sizes that they typically do, where they're based, and so on. So finding the information for institutional investors is going to be easy, a bit more complicated for angel investors, but we tackled that already. So I think that in terms of finding the right partner, right? So in terms of the investment, it's really going to go back to making sure that you know what are the things they are looking for, right? And then maybe to go back to your question as well about how do you get started. One thing to know is that if you're pitching to investors that you've cold emailed, it's not necessarily going to be a very high likelihood of success. And that's all right, right? If you want to practice your pitch, you can definitely email all the generic addresses that you can find from institutional investors. Most of them will reply, and actually most of them will even give you a chance to pitch. But you need to be aware that 90% of the cases, even more than 90%, it's going to be just the practice round, not only for you, but also for the VC, because the VCs have tons of analysts that have a quota of a number of meetings that they need to take per month, and they need to get better at these pitches and the questions that they are asking. And so basically, if you are pitching to an analyst, typically it's already an indicator about the level of interest that the VC has. And it's something that I didn't know about initially, and I was very frustrated about having these great meetings with analysts that ask so many questions, and I thought, okay, this is going to go somewhere. And then actually finding out that typically there was no follow-up. They would just maybe ask for you to send a deck, but there was no follow-up because it was just part of their process of seeing as many brands as possible. And so you gave a lot of information away. But yes, it's just a practice round.
Yeah, it's tricky, this question, because in my view, the internet is there for you to do very fundamental basic research about your investors, right? So it's very easy to go to any VC website and dig around the portfolio companies to think about ticket sizes. I think those are actually relatively easy questions to answer. The hard question is what about the profile of your investor in the way they deal with certain things. For example, how do they deal with companies, popular companies that are not doing so well? What happens when in the event of a dispute between the investor and the founders? How do they deal with such things? Those are questions that I think actually matters the most to a founder after the investment stage, right? Because there is a honeymoon period where everything is going swimmingly, everyone's popping champagne, and then thereafter the really, really difficult questions start arising. And that's where you're like, oh man, I probably should have investigated into these things as opposed to what they're going to put on the term sheet. And for that, I think the best way to suss these questions out and to find out those answers is to put yourself out there, attend as many networking sessions as you can, really attend a lot of events targeted for founders, because VCs are going to be there. Some of their portfolio companies are also going to be represented in these events. And it's a really good chance for you to speak to them and say, oh, by the way, I heard that so-and-so has invested in your company. What has that experience been like? And sure, there will be confidentiality obligations, and they will have signed an NDA or two. But over over a couple of drinks, you never know, right? Lips sometimes gets loose in a moment of frustration or joy. They say something about the investing, like, oh, right, okay, I see, I see. And then that gives you an avenue to start thinking more deeply about the kind of the profile of the investor that you want, and really to just start thinking about what happens when things do not go as swimmingly as you would have liked.
And I think because we talked a lot about the same points and also the same stage, right? We assume that everyone on the webinar is going through the seed round, but later stages are important as well. So maybe to tackle a few things there. As the ticket size is going to go up, one part of the research that you also should do, and just being able to monitor the ecosystem, is to read the news about VCs and institutional investors, because some of them that you meet, it happened to me a few times, they actually deployed most of their fund already. And so the timing is just not right. They might be interested, but they just don't have any funds to deploy at that time. Or they're still themselves raising, because don't forget, institutional investors are not investing their own money. They need to find LPs in order to get the money and therefore deploy it later. So that part is also important, especially when you go to larger ticket sizes, because if they just raise their fund, they have time to deploy it. But then, like any fund, they cannot wait years to deploy it, because behind, they themselves need to justify the fact that they have that money, that they collected money from investors that are expecting a return. And therefore, the first thing for a return is to be able to deploy that money. And so that is also something that is important. And I read one of the questions about how important is luck and timing. And yes, obviously that plays a big role. It's not something that you can control, but it also means that you need to be ready to seize any opportunity that comes your way. And the more you will be busy with fundraising, which is almost a full-time job, by the way, also something to be careful about, because when you're fundraising, you are not focused on building the company, and you need both, right? You need the money, and you need also to have the results to show, so that your pitch is going to be more convincing. If you're pitching something and then they look at the metrics and there is nothing to be excited about, you're back at square one. So very important to manage both, and just to be busy with it, and accept it takes time to get to a certain level of knowledge and of understanding. And the more you do it, the easier it will get.
Yeah, I just to build very quickly on that point about commitment periods and investment periods for especially institutional VCs. I think it's really important for founders to try to learn more about how VCs work internally, right? And to understand the incentives for your GPs and how they answer to the LPs, and think about the fund sizes, the commitment periods. These are terms that could sound really foreign to you right now, but the more you learn about them, the more you read into it, the more you understand that, oh, this is why the VC is so anxious, perhaps because they are running close to the end of the commitment period and they really need to use up whatever's left of their fund. And maybe you don't want to be in that position, because that suggests that the fund life is coming to an end, and they may expect a much shorter exit.
Absolutely. No, that's key. The investment horizon that we mentioned for angel investors, where it's actually flexible, because typically they don't have pressure other than their own wish to exit at a certain point. But for institutional investors, there is a fund life behind. And obviously, if you're telling them that you're doing an exit in 5 to 7 years and their fund life is only 3 left, it's going to be complicated at the start, right? Those are things that you can solve, right? But that's also why you need to be careful in certain of the statements that you are making at the beginning. Statements that are not necessarily going to add any value. So you can be a bit more vague or more flexible, because those are things that are typically negotiated at the shareholders agreement, in terms of when you can exit, what's the drag along right, what is the tag along right, what are the minimum multiples that you need to have, and so on. And then once you get into the Series A, for example, we did the Series A last year in August. So there we had already questions from the early investors about, okay, is there going to be a secondary sale? Can I exit if I want, or can I exit part of it? Which was something that we had discussed but not decided on. Obviously, for a founding team, for a company, helping with the secondary sale is important, because you want to make sure that your investors are happy. But at the same time, it's also bring you no value if it's done at the wrong time for you, because you will spend a lot of time to find a buyer or help them find a buyer, because typically you don't want to be too involved in that secondary sale. But the money is going to the investor, it's not going to the company. So having a secondary sale is typical of, I would say, Series B, Series C, maybe. A is very early on to have already an exit. And the reason that you can combine it at the Series B level is that typically the institutional investors coming in at that stage, they want a simple cap table. And so there it's about cleaning up the cap table, making sure that the early investors are exited. Best case scenario, they want to exit, and then there are no problems because they've been in there for 4 or 5 years. So it's time for them to take their initial gains. And the story continues for the company, of course, but with a different type of investors.
Thanks, Thomas. That was really insightful. We've had a question from one of the attendees that I'd just like to touch on, and it goes back to one of your earlier points about when you mentioned you spent a lot of time with analysts, pitching to them, answering a lot of questions. So the question is, based on your comments, should founders just avoid analyst practice pitch after the first 2 dozen or so?
I'm sorry, I was just noticing that my computer was running out of battery, so I was asking for a charger. Can you repeat the question, please?
Sure. So the question was, based on your comments on kind of analyst pitch and the amount of time it takes, should founders just avoid analyst practice pitch meetings after the first 2 dozen or so?
I wouldn't say that. And also there is no golden rule because sometimes the analyst meetings are actually bringing you somewhere. But I think that in terms of time allocation, because it's all about that, right? It's how much time are you investing in the fundraising, and in the early rounds, it's a lot. But that takes you away from the business, and you need to accept that the game is going to be that during the pitching, during the fundraising, the interested investors are going to wait as long as possible, right? Because especially if you already negotiated the valuation too early in the discussions, they're just going to wait it out and see that you are confirming on your business plan. So we're almost at the end of the quarter. Okay, how are your quarterly results for Q1? How is it going for Q2? And that's a tricky position to be in, because you are then not in control of the timeline. And again, being in control of the timeline is only possible if you have choice, and also if you have good metrics. So you see, it's like everything is intricated, and I wouldn't say that you avoid analysts, certainly not, but later stages, you should be able to defer that and have someone else from the company pitch to an analyst. And once it is confirmed that there is more of an interest and you can meet with the partner, then you go. But there is no golden rule, as Lester was saying for another question.
Yeah, I think there is still value in speaking to analysts, right? So Thomas is right that it's everyone has finite resources. The more time you spend speaking to somebody, the less time you have growing your business. It's always going to be a zero-sum game there. But the thing about analysts top interviews is that I think it's a good chance for you to ask tough questions that you may not want to ask a partner of the firm. You know, right? Sometimes you are a bit, intimidated by a panel of partners, and it's easier to ask analyst questions like, oh, what's a fund life like? What funds do you guys have? What are commitment periods like? What's your managing style? Because interviews with analysts tend to be lower stakes, right? And that use that to your benefit. Ask the questions, especially if it's a fund that you're potentially interested in. Ask the tough questions that you otherwise wouldn't want to ask a partner.
Absolutely. And the more you do it, actually, you will end up being more experienced than the analyst, right? Typically, because those are then also the fresh grad, the less experienced people in the room. So it's all about where are you in terms of your journey as a founder. But yeah, great point, Lester.
Thanks, Thomas and Lester. So we're kind of running towards the end of the webinar, and the final question I wanted to ask you both is, so we've talked a lot, everything about this initial meeting. What is there to expect after the meeting is had? So
I think that what I've learned over time is that we need to drive a process, right? Because when you drive a process, it's also indicating that you know what you're doing, and typically the investors are going to respect that and react positively to that. Because if you are just going to say yes to everything that they ask, right? Which I've done at the beginning, right? I've shared so much information with some of the earlier meetings I did that on hindsight it was completely unnecessary and even risky, because you are really providing all kinds of details. I also had in the early stages that angel investors and institutional investors would say, no, we don't sign NDA. And then I would accept the fact that they don't sign an NDA because they say they don't sign an NDA with anyone, and already share all the details, right? So obviously at the early stage of your journey, unless you are in deep tech and so on, you cannot do too much harm, right? But the more you go on, the more tricky it becomes, right? You don't want to share your exact list of customers or show your contracts before that there is an MOU, right? And definitely not before there is an NDA. So there are certain steps that you need already to anticipate, and you drive the level of information that you give, right? So initially, before a meeting, depending on the stage, you should maybe send already like a teaser so that they have something to look at, they know a little bit about your company. But then in the meeting itself, you can actually use the same teaser. You don't necessarily need to have already the full deck. And there are a number of information that you would deem sensitive that you would just say, look, as long as we haven't progressed and are beyond the NDA, this is not something that I'm comfortable sharing. And you can give a range if it's about numbers, or you can give a few examples of the type of customers without necessarily naming them. It all depends also on the NDA that you have with your customers, with your suppliers, and so on. Confidentiality is on both sides, right? And then typically the simplified process is that you have a first introduction meeting. After that, what I would expect after a successful meeting is that an NDA is signed so that you can have more detailed meetings where you have a certain level of information that you're comfortable sharing. Some would already have like a light data room, but that really depends on which stage you're in. And then there is an MOU. So basically what you need to give to the investor to get to the MOU stage is enough information so that they can build a business case and confirm the valuation that you're asking for and make you an offer, right? For the Series A, we had our own template for the MOU, and we had already a draft of the shareholders agreement. But again, these are things you can only drive if you generate enough interest that you feel you're negotiating from a position of power, right? And it's all subjective, but it cannot be too easy for the investor either, right? They need to feel that they are not the only ones talking to you. You don't need to name anyone. You can just say, of course, I'm having other meetings, but we are keeping it selective. We are not opening it up to 100 institutional investors. It's kind of creating the FOMO. And I'm going back to the sales comparison. It is selling the business at the end of the day. So you need to use the same best practices.
Yeah, Thomas is right. I think the focus right after the initial meeting, in fact, before the initial meeting, is always think about how you can protect yourself and the business. Right? So the NDA is crucial, it's really important. And do not assume that just because the initial meeting went well, you have closed the deal, so to speak. You really haven't, right? You really haven't. Thomas, from Thomas's smile, I know that he understands deeply about what I mean. The thing is, in the most dangerous position that a founder often find themselves in after a good meeting is not knowing where it's going to be headed to, right? Like, it's definitely an NDA. Why is this VC suddenly cold after such a warm and happy meeting? So don't assume that the deal is done. Keep thinking about, all right, maybe I should start meeting other investors also. Try to learn from that initial meeting. Try to meet as many people. And in the meantime, on the back end, keep the investors that you've already spoken to warm. Give them information, ask them, okay, what can I expect next? And as Thomas said, always expect an NDA, expect a term sheet of some kind. And if an investor is really keen, they'll be saying, all right, let's open a data room, and I need you to provide me like a bunch of documents just so that I can make sure that the pitch is sound, your business is sound. And that's where I think things start getting real. Make sure that you don't celebrate too early. Sign at least a term sheet first before taking a seat. But until you sign a term sheet, until you've gotten a data room in order, make sure that you keep meeting other people. Don't just meet one and then say that it's done. It never works like that.
Absolutely. And the term sheet stage, right? Then you know it's real, because that means they are going to invest their time. They are going to invest time in reviewing and maybe using third parties. Then that's even better. If they are using third parties, it means they're really interested, because they're paying for these third parties, law firms or consulting firms. So that's really showing that it's real. I would also say that, as you were saying, having other meetings, that's a given, but also making sure that you keep your options open. Very often in a term sheet or in review, they will ask for an exclusivity period. That's tricky, and it cannot be too long, because an exclusivity period, that means that you are losing time. If behind they say they're not going on, you lost a month, for example, right? So in the exclusivity period, one thing that we always did is to carve out the ongoing discussions. So we said, okay, we have an exclusivity period. We are not going to add and start new discussions, but the discussions that we're already having, we are carving them out. And that's so far always been accepted. And then also reducing it to a minimum. And it's just common sense, right? That even if they ask you why, you can simply answer, look, we have a timeline, and we want to make sure that we are not wasting each other's time. That's all. So really important to know when to push back, and because on the other hand, it's also very good for the investor, the institutional investor, that you have no choice, because once they then come to the negotiation about the valuation, about the voting rights in the company, the board seats, and all the other stuff that needs to be negotiated as well. If you're running out of time because you're running out of money, you have less power in negotiation, and therefore you are going to compromise on things that you shouldn't. And there is a conflict of interest. You never forget that the investors, they're very smart, as you were saying. The VCs are super smart, super nice people as well, but they are there to make money as much as possible. And so for them, that you have no other options than to listen to them in the negotiation, it's a good thing, right? So don't think that your interests are fully aligned with your VCs during the fundraising.
Yeah, and just one very quick point is that everything that Thomas said, it's so much to think about, which is why it's so important to start as soon as possible, start thinking about these issues, so that when a term sheet is presented to you with an exclusivity period that blocks you from talking to other investors, you are running out of money, you're desperate already, and you've got 2 days to decide whether to sign a term sheet or not. You need to be able to make that call as soon as possible. You just don't have time to waffle.
Yeah, even the fact that they would put a clock on how long you have to decide, that also doesn't make sense, right? If your company is doing well, the more you wait to sign, the more the company is actually worth. So having a clock on it already shows you what kind of investor you have in front of you, and it's not necessarily going to be like a very nice negotiation, and it might indicate that things are going to get tougher. And also it is an indication, of course, right? So the way the process is handled by the investor and how much they're trying to squeeze out of it is an indication on how the relationship will be once the funding is done and you are in the boardroom with them and looking at the results and taking strategic decisions.
Thank you so much, Thomas and Lester, for giving your time today to discuss. I think this webinar could go on for longer, but we're running out of time.
A lot to discuss.
Yes, there is. And thank you both so much. It's been a pleasure speaking to you, and I think our attendees would have gotten a lot out of this webinar. So thank you. There will be more webinars on industry topics in the coming months, and to all the attendees, you can stay updated through our social media and our Lanturn website for upcoming events. Thanks again, Thomas and Lester.
Thank you
all very much.
Thank you.
Bye.
Bye-bye.